So why is everyone talking about ChargePoint stock? Well, that could be for a lot of reasons, but I think it's partly because EVs are ramping up as we speak. Nearly every EV company is saying that they're going to increase production in 2023. And of course, if there's going to be thousands of more EVs on the roads in 2023, they've got to charge somewhere, right? So that's great news for ChargePoint and its charging networks and ChargePoint stock. More specifically, in this video, what I'm going to look at is a question and answer session that ChargePoint management held with Wall Street investors to get a more concise and precise answer to why is everyone talking about ChargePoint stock, or more specifically, why is Wall Street talking about ChargePoint stock? So let's get right into the details. You're not going to want to miss this if you're interested in ChargePoint stock, because this is going to provide a lot of insight straight from ChargePoint management, right? Straight from the source, ChargePoint CEO and CFO discussing important matters. So let's get into it. The first question comes from Oppenheimer's Colin Rush asking about the backlog of orders and the visibility into the balance of the rest of the year, and how you're thinking about the seasonal trajectory of revenue throughout the balance of the fiscal year. So if you're not aware, ChargePoint has some backlogs in their order book because of supply chain constraints. They weren't able to deliver all of the orders that their clients made. So they have some reserve orders that they need to fulfill. And this analyst wants to know, how does that look like? When are you going to fulfill those? Is there a growing backlog? So just this analyst wants more input on that backlog. So the CFO, Rex Jackson from ChargePoint, jumping in to say, from a backlog perspective, we actually did a nice job in Q4 of burning off some of that historical backlog. So he goes on to say, we're not a backlog business. We're a land and expand business. And we want product out the door and in people's hands on the ground. So we're going to burn that down. It was a nice backstop for Q4. It's a decent backstop for Q1, but we're going to work that off as we go through next year. So let me break this down. The CFO said a few important things here. First, to answer the question about the backlog, it looks like what the CFO is saying is that in calendar year 2023, they'll work through this backlog, right? They'll work through it by the end of this year, or by the end of ChargePoint's fiscal 2024. They will finish with this backlog. There won't be any more backlog. It sounds like that's what the CFO is saying, without, precisely saying that. And then the second thing the CFO said that I find very interesting about ChargePoint stock is that they are a land and expand business. What that means is they try to get commercial clients to buy their products, right? 2 charging stations or 3 charging stations initially, and to sign them up as clients, and then to try and get them to go from 3 to 5 to 10 to 25 to 50 to 100 charging stations, right? That's their strategy, is to land with a company, with an institution, with an enterprise, and then try to expand that network within that institution. And that's going to be critical, because right now electric vehicles are still a relatively small part of overall vehicles, right? So the demand for charging stations is not as great as the demand for gas stations. Overall, though, over time, that's going to grow. So if ChargePoint can get landed with some of these places, with some of these institutions, and then expand from there as time goes on, that's really their strategy. And I like that strategy. I think that's a viable strategy in this type of business, in this circumstance, for the electric vehicle industry. I feel like that's a solid business model to employ. All right, so Colin asks a follow up question. Can you talk a little bit about what trends you're seeing in terms of incremental customers that you're adding into the land part of the land and expand strategy? Okay, so the CEO jumps in, Pascal Romano, to say the rebuy rate as a percentage of our revenue in the quarter was very consistent with historical norms, which indicates that the customer add rate is holding. Okay, so that's good news that the customer add rate is holding, so that's staying consistent in terms of the amount of customers that are adding new ChargePoint stations. However, I would say it's a little bit disappointing that the number is just consistent and not increasing, because this is a rapidly growing industry with EV sales growing rapidly. I would like to see sales of ChargePoints charging stations growing as well in this metric. Overall, their revenue is growing rapidly, but in terms of the historical ad rate, it looks like what the CEO is saying is that the percentage was consistent. It wasn't accelerating. So good. I mean, it's not bad. It's just I would like to see acceleration in this business across the board, because it's just such a rapidly growing industry, right? Nearly every car company is increasing production of EVs by at least 50%. Some are doubling production, some are doing even more. So I want to see faster growth here in terms of ChargePoint. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, the next question comes from James West from Evercore, asking about, do you have a sense for how much of your business is new customers putting up charging stations versus existing customers adding to their charging networks? And the CEO sounds a little bit annoyed because he says, I mean, that's just a different way of asking the same question that Colin asked. And then he goes on to say, okay, about 30% of the quarter was new customers, and there was no deal size anomaly in that. Okay, so that's another interesting insight, and it looks like the strategy worked for this analyst, right? To ask the same question in a little bit of a different way gave us a little bit more information from the CEO. So this is why I love these earnings calls, these Q&As with analysts and the CEO, because these analysts are really, really good at getting information out of the CEOs and CFOs of companies. You see that strategy there, asking that question in a little bit of a different way, and it gave us this unique insight into what's going on with ChargePoint, something we wouldn't have otherwise known, but because of this intelligently worded question, we got this new data out of the CEO. So 30% of customers were new, and 70% was increases from existing customers. So, you know, uh, pretty good ratio here in terms of the land and expand strategy. So these 30%, I would expect to see them continue to add to their base. So these new customers, they may have signed up for, I don't know, 4, 6, 8, 10 charging stations on average, and then growing from there as the quarters go on. So the next question coming from Gabriel Daoud from Colin Cowan and Company, wants some information about margins. All right, I'm glad somebody asked about margins, because ChargePoint is losing a lot of money on the bottom line. They're burning their cash flow negative, and to me, when these companies are growing this quickly, they tend to sometimes de-emphasize or not focus on effectively growing or growing efficiently, which is a bit of a concern of mine. I like for companies, even if they're growing rapidly, to grow effectively, right? Even if that means to slow down your revenue growth a little bit so that you can get the margins right. Turn down some customers that are not willing to pay those premium prices at a rate that gives you sufficient profit margins. Or so I like that. Finally, there's a question. So let's see what the CFO says. So if you look at their fiscal year 2023, which just ended, their non-GAAP gross profit margins were 17% in Q1, 19% in Q2, 20% in Q3, and 23% in Q4. Excellent. I love to see that as revenue is growing, improvement in the margins. Okay, that's excellent. I need to see that from companies that are growing rapidly to show, to demonstrate economies in scale. So he goes on to say the supply chain thing, the supply chain problems have added about 6 or 7% of costs. Now it's more like 4%. So that helps. So the supply chain constraints are reducing and easing, and that's lowering the pressure on their cost structure. That's good news. Then they implemented price increases that they did last year. So that's also helping their margins, right? Higher prices, lower cost of goods sold means more room for margins. That's great news. Their operating expense leverage is going the wrong way in the first quarter. So the next quarter, don't expect this trend of increasing margins to continue, the CFO is saying. So there's going to be a dip, and then it's going to go back in the right way in Q3 and 4. So what the CFO is saying is in the next quarter, our margins are going to dip, and then they're going to go back up. Okay? So they did say that sequential improvement in gross margins throughout the next year. Excellent. Okay, so there's going to be a brief dip in Q1 because their sales are going to fall in Q1 sequentially. Excuse me, it's not going to decrease year over year, but the rate of growth is going to decrease in the first quarter because it's a seasonal business and Q1 is their slowest quarter of the year. I will highlight that the company said they plan to be cash flow positive in Q4 of their fiscal 2024. So what I'm seeing so far is good progress towards that trend, improving margins. And if they continue at this rate, it would truly be impressive. So I'm going to be following this stock, and if you subscribe, you'll get these updates as well. All right, that's all I've got for this video. If you like this one, there's videos popping up now that I've hand selected because you watched this video. I think you'll enjoy those that are popping up now. So please click on one of those and I'll see you over there. Thank you so much for watching.